Interest rates have skyrocketed this year, which has led to a lot of fear in the financial markets around a looming recession and concerns around the effects of continued upward pressure on rates heading into the fourth quarter of the year. According to a recent survey of 249 US based CFOs conducted by accounting and advisory firm Grant Thornton, almost 3/4 of respondents expected interest rate increases to result in a recession, and 30% of those surveyed were considering making layoffs within their own company. And with the Fed showing clear commitment to a continued rise in rates until inflation starts to come down in any meaningful way, we might be in for a pretty bumpy ride throughout the rest of the year and into 2023. But even though this all sounds very much like a gloom and doom scenario, this isn't all bad news, and for the real estate industry specifically, there are actually a few big potential upsides to continued upward pressure on rates and even a recessionary environment in the economy as a whole. So to help you start to see some of the opportunities that might end up resulting from the changes we're seeing in the market today, in this video, let's talk through why an upcoming recession might actually be a good thing for your career and how you might benefit if you're looking to get your start in the commercial real estate industry. So the first thing I'm optimistic about related to the changes going on in the market right now is that interest rate increases will end up creating a healthier real estate market over the long term by putting upward pressure on cap rates back towards historic norms. With the 10-year treasury hovering at around 1.5% throughout 2021 and below 1% throughout the majority of 2020, this resulted in incredibly cheap debt for investors, which caused real estate valuations to skyrocket across almost every asset class throughout the entire country. Real estate deals are often heavily financed with debt, meaning that cash flows and returns are also heavily influenced by the cost of that capital, and as debt became more and more inexpensive, prices in relation to the net operating income a property could generate went higher and higher over the last few years. And even though this was a huge tailwind to existing owners of commercial properties, there are two really big problems with this, both of which negatively impacted commercial real estate investors. The first of which is that cash-on-cash yields became almost non-existent in the market on the vast majority of deals acquired within the last year. Cap rates, or the NOI a property generates divided by the property's value, have dropped to historic lows since March of 2020, with 3% to 4% rates now being common in many markets across the country. And at a 4% cap rate, even if your interest rate is only 3% on a deal, those loan payments are going to end up being more than 3% of your loan amount, which ends up reducing your cash-on-cash return and the cash flow available to distribute to investors. To put this into context, if you bought a property at a 4% cap rate and financed the deal at a 70% LTV ratio at a 3% interest rate amortizing over 30 years, that cash-on-cash return drops to just 1.5%, or just over $45,000 per year in cash flow on a $3 million investment. And with low single-digit cash-on-cash returns, in order to make these deals pencil, investment firms were heavily incentivized to return capital to investors quickly to maximize the internal rate of return on the deal, leading to many investors shifting their focus to quick 2 to 3 year hold periods and a mentality that cash flow is secondary when buying commercial real estate. And for long-term investors looking for properties with solid fundamentals, it's been really difficult to find deals with so many investors willing to overpay by underwriting double-digit annual rent growth percentages and cap rates that reflect interest rates staying at or below historically low values. But as interest rates have started to rise this year in a really big way and fears of an economic contraction have continued to grow, buyers have been forced to start factoring in these increased rates and more conservative rent growth assumptions, which has started to shift the market towards healthier fundamentals. And when cap rates ultimately ease up and adjust to these increased interest rates, this creates higher cash flow yields for investors, lower LTV ratios to meet lender requirements, and less risk in the market overall, which results in more breathing room for investors and less distress in the sector if economic conditions end up going south. And with higher going in yields that can help deals pencil in a more normalized market from a cap rate perspective, this also creates more investment opportunities, especially for investors that are going into this environment with a significant amount of capital. And this leads into the second potential opportunity for you that could come out of all this, which is that if you're new to the industry or looking to break in for the first time, there are going to be a significant amount of career opportunities that are created as cap rates rise and valuations reset. According to Preqin data cited in the CBRE H1 2022 cap rate survey, there's over $365 billion of dry powder in the market right now, or capital raised for investment by closed-end real estate private equity funds. And when pricing ultimately resets and distress hits the market, those companies are going to need to ramp up their hiring and are going to be looking for qualified talent that can help them source and analyze new acquisitions, manage assets once they're in the portfolio, and even communicate with investors throughout the entire life cycle of a deal. And on top of just creating potential job opportunities, a restart in deal activity in the market can also help you get a significant amount of transaction volume under your belt once you do land a role, which can help you progress really quickly early on in your career. If real estate assets are overpriced, sellers don't sell, and buyers don't buy, and even though you might be in an acquisitions role at a larger firm, you might end up underwriting a bunch of deals, but not actually closing many transactions at all. But if there's movement in the market and all of a sudden deals start to pencil again, now you'll start to get busy and really learn how deals get done. Careers can be made during hard times, and if you start out in the business learning how to work on complex transactions, loan workouts, buying foreclosures, or finding other ways of finding and creating value when times are tough, you're going to be way ahead of other real estate professionals that only know how to make money with economic tailwinds at their back. Very similar to the video I put out a few weeks ago on the fastest ways to advance your career, starting out in a recession or the tail end of a real estate cycle is a lot like starting your career in a major gateway market. By going this route, you're putting yourself in the most difficult environment first and being exposed to a wide variety of tough situations, which will make everything you take on in the future feel much simpler when the market ultimately turns back in your favor. Now, obviously, I don't know for sure what's going to happen with interest rates or cap rates or the commercial real estate market as a whole, but if things do continue to trend in the direction they've been heading throughout 2022 so far, these are two big and often overlooked upsides that I see in this type of scenario. And regardless of how market conditions shift, if you want to make sure you're ready for opportunities to land analyst and associate roles at top commercial real estate firms looking to deploy the dry powder that they've raised, as always, make sure to check out our all-in-one membership training platform, Breaking into CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the state of the commercial real estate market and how that might affect you, make sure to hit the like button and let me know. And let me know in the comments where you see cap rates going throughout the rest of the year and what kind of opportunities you think might come up from that change. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.